Chris Waterman, Managing Director and Head of EMEA's insurance team at Fitch Ratings, outlines for news insurances the influence of sovereign debt ratings and that of new players in the reinsurance market. But first of all, we have asked them what the 2011 earnings will look like.
2011 year has been a fairly tough year for the reinsurance market so far. We've seen a significant number of major catastrophes, starting with the Japanese earthquake back in March. We've seen earthquakes in New Zealand, and there's been significant activity in the United States with hailstorms and tornadoes. So much so that the first half of the year we've seen in excess of $50 billion of insured catastrophe losses that are impacting the reinsurance market. Not surprisingly, results for reinsurers for the first half year have been quite poor on the back of that. The remainder of 2011 is uncertain in terms of the total profitability and earnings for the year. It's not going to be a very profitable year in terms of underwriting. Our expectation of Fitch is that the full year combined ratio will come in somewhere around 108% if we see normal catastrophe activity through the remainder of this year. And that compares with 95% combined ratio for last year, so a significant deterioration. The results for 2011 will be heavily driven by the US hurricane season and any other catastrophic events that we see before the end of the year. The ratings of sovereign debt held by reinsurance companies can impact their financial strength. At Fitch, we've done a significant amount of analysis on the portfolio of reinsurance companies that we follow. And we've identified that the reinsurance industry in general holds fairly conservative assets on their balance sheets. Many reinsurers do have some exposure to the so-called PIGS countries, and that exposure has diminished over the last year, so reinsurers have been de-risking their portfolios. And we've stress tested reinsurers' balance sheets to potential default in those countries. And our current expectation is that the reinsurance industry is well capitalized and certainly strong enough to withstand the magnitude of losses that would come through. I think the bigger concern would be if we see contagion beyond the peripheral countries that we've been reviewing for this stress testing, and get a much broader contagion in Europe, and that clearly could have an impact for the reinsurance sector, and particularly for European-based reinsurance companies. We haven't seen a lot of new players in the reinsurance industry over the last few years. The reinsurance industry is very well capitalized. There's a lot of capital, a lot of capacity chasing a defined amount of premium income. Typically, we see new entrants into the market following a period of where capital is taken out either through catastrophic losses or through dislocation in investment markets. New capital comes in to fill the space. So over the last few years we haven't seen a lot of new startups, and our expectation here at Fitch is we won't see significant startup activity unless there is more large catastrophic events during the remainder of the year, this year and into next year. We have seen, however, the development of a few reinsurance sidecars. These are vehicles that provide additional capacity, operating on a quota share basis with traditional reinsurance companies. And these vehicles provide investors an opportunity to invest for a limited period of time into markets that are perceived to be technically profitable. So following the Japanese earthquake and the New Zealand earthquake, there has been some demand among investors to provide sidecar capacity. What I would say is that sidecar capacity hasn't been of the same sort of magnitude that we have seen after other catastrophic events. So for example, in 2008 there was much more in the way of sidecar establishment than 2005, which were very big catastrophe years. And the reason we haven't seen the sort of volumes of sidecar development that we have historically is simply because of the very high levels of capital that remain within the reinsurance market.